Welcome to the Deep Dive. We're here to unpack the key takeaways from the latest corporate earnings calls. Today, we're digging into Charter Communications. You probably know them as Spectrum.
That's right. We're looking at their recent earnings call, trying to figure out what's really going on behind the numbers.
Okay, so let's start with the top line. What did the results look like overall?
Well, the headline number for revenue was relatively flat compared to last year.
Flat. Okay. Doesn't sound too exciting initially.
Right, but dig a bit deeper and you see their EBITDA growth actually accelerated pretty nicely, up 4.8%.
Oh, interesting. So profits improving even if revenue isn't surging. What's behind that?
Yeah, it seems to be a combination of things. Mainly, their mobile business is really taking off, and they're seeing some benefits from service quality improvements.
Mobile. Okay. I did see something about that. Big numbers.
Huge numbers. They added over 500,000 Spectrum mobile lines just in this quarter.
500,000. Wow.
Actually, 514,000 to be exact. And if you look at the whole year, it's over 2.1 million lines they've added. That's like 25% growth year over year.
25%. That's massive for mobile. Makes them the fastest growing in the U.S., right?
That's what they're claiming. And the numbers seem to back it up. It's a big part of that EBITDA story.
Okay, so mobile is clearly a bright spot. What about the traditional internet side? How did that fare?
Internet was, well, a bit more mixed. Their results did improve compared to last year, which is positive.
But I sense a but coming.
But they did report an overall loss of internet customers this quarter, about 60,000 net loss between residential and small business.
Okay. And that's even with the Affordable Connectivity Program ending, right? That was expected to be a headwind.
Exactly. So the fact that year-over-year performance improved despite losing ACP is something, but yeah, still a net loss in the quarter itself. Competition's tough out there.
No kidding. All right. Mobile booming, internet facing some pressure. What about the video side, traditional cable TV?
Actually, some relatively good news there. Or maybe less bad news.
Okay. Less bad news is good news in cable TV these days.
Pretty much. They lost video customers, sure, about 181,000, but that's way better than the same time last year when they lost 405,000.
Whoa, yeah, that's a significant improvement in the loss rate. Any idea why? New deals.
It seems like their new pricing and packaging, maybe bundling strategies, are helping slow the losses, plus that Life Unlimited brand thing they launched.
Gotcha. Okay, let's look at the financials overall then. Cash flow, share buybacks.
Yeah, looking pretty solid there. Free cash flow is strong at $1.6 billion for the quarter.
$1.6 billion. That's a big jump from last year, isn't it?
It is, yeah, a substantial increase. And they're putting some of that cash to work, buying back $750 million of their own stock just this quarter.
Okay. Solid cash flow, returning capital. Let's go back to that mobile success for a second. What's the tech behind it? Are they just reselling someone else's network?
Well, that's the interesting part. They say less than 13% of their mobile traffic actually goes over the big macro cell towers.
Really? So where does the rest go?
It runs mostly on their own network. Their gigabit capable broadband network infrastructure. They're leveraging their existing footprint.
Smart. Using what they already have.
Exactly. And they're deploying CBRS spectrum too. Think of it like their own mini cell towers. They expect that in 23 markets by year end.
Okay, so they're building out their own mobile capabilities on top of their cable network. This whole converged network idea.
Precisely. And they see a lot more room to grow there. Right now, only about just under 20% of their internet customers also take their mobile service.
So a big internal market still to tap.
Right. And it's not just about selling more mobile lines. They're finding that bundling mobile helps them get new internet customers too. And crucially, it reduces churn.
Yeah.
People stick around longer if they have both internet and mobile.
That bundle stickiness makes sense. So that helps offset the internet pressure we talked about.
That seems to be the strategy, yes. Even with the ACP headwind gone, they feel the underlying internet trends are actually improving, partly because of this bundling effect.
What about fiber competition?
Yeah.
Everyone's talking about fiber rollouts.
They acknowledge it, of course. They're doing some fiber buildouts themselves, expanding their footprint. But interestingly, they sounded a bit cautious about the financial returns on some of these aggressive fiber overbuilds happening in the market.
Cautious. You mean they think others might be overspending?
They didn't say that directly, but they implied they think their approach, upgrading the existing network, might be more capital efficient in the long run. They also mentioned that the threat from cell phone internet, like 5G home internet, seems to have plateaued a bit.
And people are still using more and more data on broadband, right?
Oh, absolutely. They threw out a number Non-video internet customers are using around 825 gigs a month on average.
825 gigs, wow.
Yeah, and get this, over 30% of those customers are using more than a terabyte every month.
A terabyte. Okay, so the demand for fast, reliable internet isn't going anywhere.
Definitely not. And again, they tie this back to the bundle. Converged households, internet, and mobile have significantly lower internet churn. The more mobile lines a household takes, the lower the churn.
It all comes back to the bundle. Let's talk network upgrades. You mentioned they prefer upgrading existing infrastructure. What does that involve?
The key technologies are DOCSIS 4.0 and what they call high split. Think of it as significantly boosting the capacity of their existing cable lines.
Boosting capacity, how much?
Enough to offer speeds up to 10 gigabits per second eventually. And importantly, this upgrade also helps power the small cells needed for their mobile network expansion. It's all interconnected.
So upgrading cable also boosts their mobile network. Efficient.
That's the idea. Plus, they're continuing to expand their physical footprint, reaching new homes and businesses. And they mention investments in AI and machine learning.
AI, how are they using that? Not for chatbots, I hope.
Maybe, but they emphasize using it more for their frontline workers, making things easier, more efficient for techs and support staff. They claim it's already reducing repair calls and truck rolls, fewer technician visits.
Okay, improving service and cutting costs.
Right.
Makes sense. How are they pitching all this to customers? What's the value proposition?
It boils down to best network, best products, best value, best service. That's the mantra.
Standard marketing talk, maybe?
A bit, yeah, but they try to back it up. They highlight savings compared to competitors, especially with bundles. They emphasize their US-based sales and service teams.
That's a differentiator these days.
It is. And they even launched a new employee stock purchase plan, trying to align employee interests. Plus, that Life Unlimited brand refresh we mentioned, it comes with promises about reliability, same-day service, credits if they miss, trying to build trust.
And the pricing, are they just discounting heavily?
Not exactly discounting individual services, but structuring bundles so the overall package is attractive. The goal is actually to grow ARPU, average revenue per user, by getting people to take more services, like faster internet speeds or adding mobile and video, even if the internet price within the bundle is lower.
So sell more stuff to the same customer.
Basically. And it seems to be working for speed upgrades. They said their gigabit internet take rate nearly doubled year over year.
Wow. People want faster speeds.
Apparently so. And they push the customer-friendly stuff too. No contracts, price locks on bundles, taxes and fees included in the advertised price. Trying to remove friction points.
Okay, let's circle back to video and this seamless entertainment thing. That sounds different.
It really is. Remember how video losses slowed? Part of that might be the bundling making video cheaper. But the seamless idea is the more interesting angle.
Explain that. What is it?
They're integrating major streaming apps like Disney Plus Rabs, Max, Peacock, Paramount Plus C, ESPN Plus directly into their Spectrum TV Select package.
So you get the streaming services with your cable package?
Yeah.
Essentially, yes. You access them through their platform, either via TV Everywhere or direct authentication within the Spectrum environment. They're even working on letting you upgrade the ad-supported versions to ad-free seamlessly.
Huh. So they're trying to become the central hub for everything, cable and streaming.
That seems to be the play. They're even launching a digital storefront later this year to sell these streaming apps directly to their broadband-only customers too.
And the streaming companies are okay with this?
Charter says yes, the programmers are supportive. They see Spectrum's internet base as a huge distribution platform. Charter claims this adds over $80 in value to their TV Select package now.
That's a significant value add. Trying to make the cable bundle relevant again by including the stuff people were leaving cable for. Clever, potentially.
It's definitely an interesting strategy to watch, adapting rather than just fighting the tide.
All right, let's get back to the nitty-gritty financials. Any quirks in the reporting? Guidance.
They mentioned some expense reclassifications to line up with the Spectrum brand launch, but importantly, it didn't change the bottom line numbers like operating expenses or adjusted EBITDA.
Okay, good. What about costs? Programming costs still a killer.
Actually, programming costs went down, mostly because they lost some video subs and people shifted to smaller, cheaper packages.
Makes sense. But other costs?
Other costs of revenue went up, mainly because they sold more mobile devices and had higher costs associated with the growing mobile business. But Offsetting that, the cost to actually service customers went down.
Down how?
They credited productivity gains, likely from more experienced, tenured staff, maybe helped by those AI tools they mentioned, reducing service calls. Marketing costs were up, though tied to getting new customers and that Life Unlimited launch.
Okay, a mixed bag on costs. What about capital spending, CapEx?
CapEx was actually down year over year, but they said that was mainly about timing of payments and projects. Their outlook for 2025 capital spending is still around $12 billion.
$12 billion.
Yeah.
Still investing heavily then.
For now, yes. But the key message was looking further ahead. They expect strong free cash flow growth in the coming years.
Why the optimism?
Because they see the peak spending on their big network upgrades, that DOCSIS 4.0 rollout, and their rural footprint expansion starting to wind down after 2025 or so. Less spending means more free cash.
Okay, so invest heavily now for future cash flow growth. And they plan to use that cash how? More buybacks, debt reduction.
They mentioned planning to gradually increase their leverage, meaning take on a bit more debt relative to earnings towards the middle of their target range. And they explicitly said they expect to grow EBITDA in 2025.
Growing EBITDA in 25, strong free cash flow after that. That's the forward-looking story. How do they see the competition playing out?
They know it's intense, but they feel the worst of the ACP impact is over. With fiber overbuilders, they say the impact on their market share has been pretty consistent, pretty predictable.
So no surprises there.
Apparently not for them. They still believe they hold on to customers better than the fiber guys, even when competing head-to-head for a long time. They see mobile substitution and fixed wireless as factors, but maybe less threatening than previously thought.
And the economy. Are customers cutting back? Feeling pinched?
They said they haven't really seen significant negative impacts yet. Sales are actually up and churn is stable. Their view is that their bundles offer good value, which might even appeal more if we hit a recession.
Offering value in tough times. And they have different package tiers too, right?
Yeah, various options to hit different price points for people who might be income constrained.
One last thing, tariffs. Any impact from trade issues, tariffs on equipment.
They don't expect any major impact on their spending or their P&L. They mentioned preferring U.S.-made products if available and priced right, but tariffs weren't flagged as a big concern.
Okay, so putting it all together, the picture is strong mobile growth is really carrying the story right now.
Definitely. That, combined with the seamless entertainment strategy, trying to stabilize video, and the path towards much higher free cash flow in a couple of years as network spending peaks.
And they seem pretty confident they can hold their own against fiber, leveraging that converged network.
Yeah, that's their core belief. The efficiency of upgrading versus overbuilding, and the stickiness of the internet mobile bundle.
All right, makes sense. So that brings us nicely to our This Is Not Financial Advice segment. Time for a slightly out there idea based on all this.
Let's do it. Okay. Thinking about their focus on network control and mobile growth. Here's one, the Spectrum play.
The Spectrum play. Okay, I'm intrigued. Buying more Spectrum.
Exactly. Not necessarily buying a whole competitor, but strategically acquiring more wireless Spectrum licenses, maybe from smaller players or grabbing chunks in auctions.
Why would they do that? They're already using CBRS in their own network a lot.
True, but owning more licensed spectrum directly gives them even more control, reduces reliance on partners or shared spectrum like CBRS long-term, and gives them more capacity and flexibility for future tech 5G upgrades, maybe 6G down the line.
So doubling down on owning the infrastructure, the airways themselves.
Right. It would cost a lot up front, obviously. Wall Street might initially balk at the capital expenditure.
Yeah, billions, potentially.
For sure. But long term, if you believe convergence is the future and network ownership is key, locking down more spectrum could be a very powerful strategic move. It solidifies their position as a true infrastructure owner across both wireline and wireless.
The Spectrum play. Definitely bold. Adds another layer to their network strategy.
It's a contrarian thought, perhaps, given the cost, but it fits the narrative of network control being paramount.
Interesting food for thought.
Okay.
Okay, that wraps up our deep dive on Charter Communications' latest earnings.
Key takeaways. Mobile is the engine right now. Video is trying a very interesting adaptation with streaming integration. And the big promise is that wave of free cash flow coming once network spending cools off.
Exactly. We hope this breakdown gave you some valuable insights. As always, remember this is just our analysis. Do your own homework before making any investment choices.
We'd love to know what you think. Is Charter's seamless entertainment the right move? Can they really fend off fiber long term? Let us know.